1,000 euros per month net to fill that pension gap.
So half of your income.
Yeah, so 1/3 of your income.
Of your income.
So 1,000 euros of the 3K you make, you would have to put aside.
Just for retirement.
Just for retirement, just to have the same living standard. So you see, like with a 3% interest, that won't get you far, right? And even if you can save 1,000 euros, you definitely don't want to,
yes,
right?
Because you want to live your life.
Yeah, you want to live a life like you're working hard, you're having a good salary. You don't want to say, okay,
save all my money.
I save all my money for later. Yeah, right.
Okay. Now we spoke of the German system and why the pension is so low. So now we will go on to the topic, what can we do against it? And of course, it's a long time. If you think now on retirement planning, most of your clients are, I don't know, maybe you can say it by yourself.
Yeah, the average is like 30, 35.
Yes. Yeah. So 30 years in advance, you have to think 30 years in advance and further, because you don't die with 67. You hopefully live a long life. And then you need money, of course.
Yeah.
So basically, what is your advice if you think of long-term investing, especially in terms of safety and retirement planning?
Yeah. So the most important aspect is that you get a good interest. Because without a good interest, you will never reach your retirement planning goals. So first you have the inflation, right, that eats on your money. So you have to beat the inflation with the interest, and you have to put basically have to do a percentage on top to reach your retirement goals, because the higher the interest, the easier it is to put money aside for retirement. So for example, just as a comparison, if you take like classic products like let's say you just leave the money at your bank account, and let's say you get 3% interest, right? Then when you have a 3K salary net, right? So that's 60K a year approximately, and you are around 30, then you would have to put aside 1,000 euros per month net to fill that pension gap.
So half of your income.
Yeah, so 1/3 of your income. Of your income. So 1,000 euros of the 3K you make, you would have to put aside.
Just for retirement.
Just for retirement, just to have the same living standard. So you see, like with a 3% interest, that won't get you far, right? And even if you can save 1,000 euros, you definitely don't want to, right?
Because you want to live your life.
Yeah, you want to live a life like you're working hard, you're having a good salary. You don't want to say, okay,
save all my money.
I save all my money for later. Yeah, right. Okay. So yeah, and in the same scenario, when you have a 7% interest, right? The monthly rate cuts itself in half. So it gets 500 euros per month. And when you have a 9% interest, then it's, I think it was like 350 approximately, right?
And that's fair. So you can save 500 euros.
Yeah, 350 to 500 is very realistic with that salary. And that's how you reach your retirement goals. So a very important aspect is that you get this good interest, right? In order to get this good interest, you have to invest your money, because you don't get a good interest with a bank or with a Bausparvertrag or with a Riester pension, all these old-fashioned products. Basically, you have to invest your money, right? And what are important aspects when you invest money? The most important one is broad diversification, because for your retirement, you want something that is really, really safe. You are relying on this money. You have to have this money. You cannot put it on a gamble or on a risk, right? So the most important aspect is broad diversification. So what we do, we have a retirement planning portfolio that we always update, and which is basically the most broadly diversified portfolio there is, right? So we have over 10,000 companies that are invested in with a monthly rate, from the industry countries, from the emerging markets, and from big companies, small companies, from technology, from conservative business models. So the whole spectrum we invest in, and that's what gets you the most safety. And also historically, it's a very safe investment, because when you save monthly, after 15 years, you never had a loss actually, right? So there will be
15 years.
15 years, right? So when you just hold it for 15 years, so that's a stat.
You're almost risk-free.
Yeah, and over 30 years, like the minimum interest that you get is 7%. That's why I calculated with the 7%. Of course, you have to deduct inflation, but over a long time, fund investing and broadly diversified funds investing is very, very safe. And that's what we do for our clients to implement that strategy, that they are the most safe and at the same time have a good interest for their retirement.
Okay.
Yeah.
Okay. So if you are thinking of investing in funds or ETFs or in stocks in general, most of the people comes in mind like I open a brokerage account at my bank and then I just start. What are the benefits of or why you would take those ETFs or funds into a insurance, not into a brokerage account?
Yeah. So first of all, I have absolutely nothing against a broker account. I myself have a broker account. We offer broker accounts to our clients also. And for the short to midterm investing, a broker account is perfect, right? What the benefits are from insurance in the long term is the topic taxes. Right? Because if you don't have a tax advantage, you pay a lot of taxes, right?
Yes.
And with the insurance policies, the German government gives you massive tax benefits when you invest for your retirement. There are different benefits with different plans, right? Mm-hmm. But the tax benefit is always very high, that over the long term, you have more tax benefit than you would have cost from the insurance.
Okay. Is there any other benefit than tax benefit investing in insurance?
Yeah. The insurance basically makes your life a lot easier, right? The insurance takes care, if it's a good pension insurance, takes care that you don't have to worry about the investment or the insurance at all. So to give you 2 examples, for example, when you have a portfolio of funds, then you have different percentages, right, in which the funds are invested in. And what the insurance does, they have a rebalancing service. That means every year the percentage of the funds is rebalanced into the right percentage again. Okay. So you never basically have to worry about the investment. So that's one example where the insurance makes your life a lot easier. The second example is when it comes to retirement, and that's really the big part also in insurance, it's the long-term retirement aspect. Because you can imagine when you get close to retirement and you have your money in funds, the funds are volatile, right? Yes. So the funds are depending on the world economy, and when the world's economy is doing great, then the funds go up, and when the world economy is doing bad, then the funds go down, right? Overall, they go down over a long time, but we all know that there will be crises, and there have always been crises in the past, and then there can be periods where funds go down over a couple of years, right? Yes. And what you don't want for your retirement,
like we've seen in 2022.
Yeah, so 2022 was a year where we saw that, last year with the whole Russian-Ukrainian war, etc., and China and all these crises. Also 2020 with Corona, 2008 with the banking crisis. So there are periods where funds are going down. And what you don't want, and they go up again after that time, right? But what you don't want for your retirement, that let's say you want to retire with 67, and then two or 3 years earlier, or 1 year earlier, you have a huge financial crisis, or the world economy is doing bad, and your funds go down. Let's say 30%, right? So that would mean that you now have 30% less money that you would have a year ago. And you basically have 3 options, right? You can take the 30% less and retire. You can wait a couple of years until the market recovers.
Not a good option if you don't have income anymore.
Yeah. Most people don't want to do that, or work longer, right? Or you take care of that matter beforehand, right? And what the insurance does, and it is called Ablaufmanagement in German, but basically what it does, 5 years before you retire, you go and take your pension. The insurance comes and takes the money out of the funds part by part into their own assets, which basically work like a savings account. You vary view volatility, but you get 3% interest approximately. Okay. Right? So the insurance ensures that you have a stable portfolio when you retire and a worry-free retirement. So these are, like, just as an example, 2 points where the insurance makes your life a lot easier, right? And then, of course, there's the tax advantage, but we will talk more about that later, I think.
Okay.
Yeah.
Sounds fair. But yeah, and I guess there are more options and more benefits you talk about with the clients individually.
Yeah.
Because It's not for all the same,
Yeah.
of course. But yeah, sounds nice.